Get the best out of the markets again. You have witnessed it in 2016. (2018). 2020. Kotak Equity Colloquium is back. One of India's largest knowledge-sharing platform on the markets. The Kotak Equity Colloquium. From Kotak Mutual Fund, India's 6th largest mutual fund. Join the biggest names in the industry. Gain knowledge from their market insights. Get trends and analysis and the forecast for the future. Use their experience and share it with your investors. Deep dive into sectors which will drive the future, which may help you grow your money like never before. Get brand new perspectives and all the tools you need to grow your business. Inviting you to join the Kotak Equity Colloquium.
Good evening, friends. Welcome to Equity Colloquium 2020, the knowledge sharing platform presented by Kotak Mutual Fund. Today we have with us Harsha Upadhyay, our Head of Equities, Shivani Kurian, Fund Manager and Head of Research, and Ashish Chopra, our Analyst on the IT sector. We will begin this presentation with Harsha, who will talk to you all about our investment philosophy and investment process, followed by a presentation on the IT sector by Shivani and Ashish Chopra. I hope you all will find this session informative, and this is first of its series of many more such sector presentations to come as we move ahead. So without not taking further time, welcoming all of you all once again, I hand over the podium to Harsha Upadhyay.
Thank you, Manish. Good evening, dear partners. Hope all of you and your families are safe in this environment. It's been a challenging 2020. The distances have grown. However, we are bringing you a digital version of Equity Colloquium 2020. We have participated in various Equity Colloquiums in the past. I'm sure you know what we discuss in many of this. In the earlier ones, we had discussed investment insights from our team. What are the do's and don'ts of investment that we follow? What are the principles that we adopt to make our investments? By doing that, I think we shared a lot of insights on various sectors that are prominent in our economy. We also looked at various factors which affect consistency or which give aid to consistency. For example, the stability of the team. I'm happy to report to you that most of the research analysts and the portfolio managers who were present during the first round of Equity Colloquium are still part of the team. So our team has been one of the most stable teams in the industry. This expertise and the stability of research team and the investment teams brings a lot of intangible strength to the overall investments. And we are also a fund house which focuses more on fundamentals, and we are a fundamentally driven research and investment oriented fund house. We really do not take tactical or event based bets. And we also focus on cash profits rather than accounting profits. These are some of the discipline that has been continuing in our investment team, and because of which we have been able to really consistently perform throughout various market phases. If you recall earlier Equity Colloquium, we had also spoken about various sectors during one of the Equity Colloquiums. The entire research team had spoken about their set of respective industries and what are the triggers, what are the drivers for those industries. Continuing on the same lines, this time around we are making it more in-depth, and this is first of the series. We want to do a series of such Equity Colloquiums where we will discuss in-depth industry studies. And this time around, we are taking up IT sector. Why are we talking about IT sector? I'm sure all of you have seen how technology has transformed each and every business, and it is continuing to do so. The market cap leadership has gone to mostly tech companies across the globe. In this environment, we need to debate and see whether Indian IT companies are going to be part of this entire tech transformation, and if so, what are the advantages that Indian IT industry will have. We are going to discuss over the next half an hour or so uh, industry outlook for IT sector. What are the growth uh, uh, drivers for the industry? Where are we headed? Whether the valuations, after a stupendous rally that we have seen in the last 6 months, whether the valuations are in the fair zone, whether there is more money to be made over the medium to long term. If so, whether we should be investing in large caps or mid caps or both of them. What are the risks that are there in the industry? These are some of the things that we would like to discuss over the next half an hour through this equity colloquium. And today we have Shibani, who is our head of research, and Ashish Chopra, who is an IT sector specialist from our research team, talking about some of these factors over the next half an hour. Let me introduce both of them to you. I'm sure most of you know Shibani Kurian. She has been with the company for more than a decade. She has a very rich experience of nearly 2 decades, covering various sectors in the economy, and also she has been part of our team for more than a decade. Now she is heading the team as well as managing a couple of funds in the last 2 years. As far as Ashish is concerned, Ashish comes with a rich experience of more than a decade covering IT sector. He has been with Kotak for a little longer than 2 years now, and he has been covering IT in Kotak Mutual Fund, and he will also be presenting his thoughts on the IT sector along with Shibani. Over to you, Shibani.
Thank you, Harsha. Hello, everyone. I hope that all of you are safe and doing well. Technology certainly is everywhere. It's empowering every consumer and transforming every sector. In the words of the science fiction author Arthur C. Clarke, any sufficiently advanced technology is equivalent to magic. Therefore, let us see whether investing in IT stocks creates that magic or not. The era of technology is here. Now, as a nation, we love our cricket. We know that in the 70s and 80s decade, the West Indies was the dominant team. That gave way to the mighty Aussies in the 2000s. And today is the time for the men in blue. Similarly, the era of technology is finally here. From oil being the new black gold, we've come a long way to data being the new oil. Software is clearly eating the world. When you look at the companies in terms of their market capitalization, in 2005, among the top 5 companies, there was only one technology company. That changed in 2015 to 3. And in 2020, all the top 5 companies by market capitalization are technology companies. Technology leads the US market cap charts. However, the Indian service model is still not up there. If you look at the top 10 companies by market capitalization in India, in December 2000, there were 2 companies, Infosys and Satyam Computers. We all know what happened to Satya. In 2020, the situation is only marginally better. There are 3 companies in the top 10. Isn't it a little strange that the same Indian companies which provide services and support digital disruption are not dominating the markets? Technology actually has spared no industry in its quest. The retailers, they fear Amazon. I'm sure in the COVID times, all of us know that we almost every day get a delivery from Amazon. When was the last time you actually hailed a Kali taxi? The way we watch movies has changed because of COVID. In fact, cinemas today fear getting obliterated by Netflix and Amazon Prime. And did you know that the most downloaded app in the hospitality sector was that of Airbnb? In fact, the total number of app downloads by Airbnb was far more than that of Hyatt, Marriott, Hilton, and the Accor group of hotels all put together. Even the biggest sector of them all, the big daddy, the financial services sector, has not been spared. There is an ever-increasing influence of fintechs, and that is palpable for banks. It is estimated that nearly 2/3 of customers globally are using fintech products or services. And today, bankers are actually underestimating how their customers feel about fintech services. In a survey done, bankers, only 40% of them felt that fintechs provide a good experience. However, the customers had a different tale to tell. 80% of customers felt that fintechs provide a good experience. If you look at the cars, today automobiles are no longer mechanical in nature. In fact, did you know that the lines of code written for a car today is far more than that for a passenger aircraft or even for a modern fighter jet? Let us look at what has happened with Tesla. Now, in terms of market capitalization, as you know, Tesla is far, far ahead of Toyota, Volkswagen, BMW, GM, to name a few. But did you know that in terms of number of cars sold in 2019, Tesla sold only 0.4 million cars? Contrast to that, Toyota and Volkswagen happening is that investors are chasing companies where they believe that these companies represent the technology of the future. And therefore, these valuations may not fit into any traditional investing framework. And we need to look at valuing these companies very differently. Today, actually, every company aspires to become a software company, whether it's financial services, FMCG, or pharmaceuticals. In every industry, technology is the way forward. Did you know that the Goldman Sachs CEO actually said that Goldman Sachs is a technology company and not a financial services company? JP Morgan Chase has a team of almost 40,000 technologists. Therefore, Pizza Hut, Johnson & Johnson, Hindustan Unilever, all of them, to name a few, are using technology to improve their overall business models. Let us look at a case study of Goldman Sachs. This case study tells us how technology is the biggest competitive edge that a company can possess and also a threat. In the year 2000, Goldman Sachs actually had 600 traders. By 2017, the number of traders came down to only 2. Traders were actually replaced by hundreds of computer engineers. And it is believed that more and more staff will get displaced over the next few years as advances are made. So how did they actually manage this? They created a powerful analytics database, and that database managed risk and also carried out their operations. In fact, the Wall Street Journal estimated a value of almost $5 billion to this powerful analytics database. And also, by offering this tool directly to clients, Goldman Sachs almost eliminated the process of middlemen. Today, because of COVID-19, the way we live our lives has changed. It's possible even after a solution or a vaccine is found for COVID, we possibly will not go back to the near normal that was before this entire pandemic broke through. Digital transformation has changed the world around, but because of COVID-19, digital transformation has moved from a marathon to a sprint. In the words of Nandan Nilekani, imagine if this pandemic had happened 20 years ago, we would not have been able to do anything at all. And that's because technology has helped us today. Satya Nadella himself said that 2 years of digital transformation has taken place in 2 months. Clearly, as I said, we've moved from a marathon to a sprint. And now I hand it over to Ashish Chopra to examine what are the opportunities that are present today and what are the key risks for the sector and how we can invest in the sector. Over to you, Ashish. Thank you.
Thank you, Shivani, and good evening, everyone. So over the course of next few minutes, I will try to link some of these technology transformation trends that Shivani spoke to you about to the Indian context. But before that, Let us just put the opportunity in numbers. Now, NASSCOM expects the spending on digital to double from 2019 to 2023, growing at a CAGR of almost 20%, all the way up to $2.7 trillion. The biggest opportunity in this technology stack will come from cloud computing, which is almost a fourth of this technology spend. And cloud computing is also the most immediate opportunity at this point of time, with enterprises across the globe accelerating their journeys to the cloud. And once the enterprise technology architectures are adopting to the cloud, it makes way for them to leverage a lot of other technologies in the digital stack that you view on this slide, the likes of Internet of Things, blockchain, robotics, big data analytics, etc. Now, let me lead that as a segue to share some perspective on the Indian IT services industry. The industry has been a key cog in the wheel of technology transformation for global enterprises over the last few decades. The largest companies across the globe have been procuring software services, the qualities of which match the global standards and the price points of which very few countries across the world can compete with. However, labor arbitrage has not been the only proposition that this industry has had to offer. In fact, over the last few years, the industry has been moving up the value chain and providing higher value-add services to its customers. Now, two charts at the bottom of this slide substantiate that point. The Indian IT industry added $68 billion of revenues between 1999 to 2009, whereas it added a much higher $105 billion of revenues between 2009 to 2019. However, in each of those instances, it added only 1.9 million employees, and not higher number in the last decade as compared to the decade prior. The second instance is when we look at the revenues that Indian IT gets from newer technologies, which are classified as digital revenues by the industry participants. These digital revenues contributed only 10% to their top line in 2014, which went on to increase to 28% by 2019. It is higher than 30% at this point of time today, and NASSCOM expects this to grow all the way up to 60% by 2025. Now, because labor arbitrage was not the only proposition, the industry has managed to retain, if not grow its relevance through waves after waves of events that reshaped the way the technology was bought. Having kicked off in the Y2K era, what followed was a period of very large IT offshoring, mainly by the US, and then also some of the English-speaking countries in the UK and continental Europe. However, after the global financial crisis, what we saw was that even the non-English speaking countries started offshoring to India in a much bigger manner. And this was thanks to Indian companies building capabilities in those other languages as well, either via acquisitions of some companies in those regions or building some of those capabilities internally, and hence continue to stay relevant. Now, there was a concern when customers started spending on digital technologies that they would be cutting back the spend on legacy IT, and hence the Indian IT would lose its relevance because we did not have capabilities on these newer technology stacks. However, all digital technology has done is it has ended up sparking a new growth wave for Indian IT companies, and hence now this has become the biggest driver of their revenues over the last few years and will continue to be so in the years to come. In this very vein, as we reimagine the world in the post-pandemic era, one thing that is very clear is that technology will be a dominant force, much more than what it has been before. And this time around, there is a greater degree of confidence that Indian IT will have a key role to play in the scheme of things. Now, how did we manage to make it more relevant this time around than before? As you would view in this slide, as we roll forward to 2019, there are newer blocks of revenues that are contributing to the top line of this industry. The technologies such as cloud, business intelligence and data analytics, artificial intelligence and machine learning, which were not really the scope of the offerings of Indian IT, back when they used to offer traditional services. However, not only do they continue to offer the traditional services like application development, BPO, software product development, even those services have grown in the last 10 years, and Indian IT has added on these new opportunities on top of that. The growth in traditional services has been fueled by them continuing to gain market share from their global counterparts during this period of time. Now, how did we add these new blocks of technologies where we did not really have many capabilities in the past? When digital technology was new, almost every expert and advisor in the IT services market felt the need for enterprises to adopt these technologies. But they felt that the key constraint was really the talent and the skill set that was not available to offer to the customers. And that is where the DNA of learning, which is embedded into the business models of Indian IT right from its nascent stages, came to their advantage. Now, Indian IT companies for a lot of time had been hiring fresh graduates from campuses and putting them through these training centers before deploying them into the client projects. And when they felt the need to retrain them in digital, they upgraded these same training facilities and built their own platforms, this time around, not only to train the fresh graduates, but also to retrain and reskill their lateral employee base so that they could tap on to the digital opportunities. And many of these companies had their own platforms, as you would see the examples in this slide. Infosys had Lex, TCS had Ion, Mindtree had Yorbit. Now, if these platforms were not capable of imparting some of the skills, the industry has also gone on and partnered with third-party platforms such as Udacity, Future Skills, and Coursera. And even if that was not sufficient, what we have seen is that the industry has gone on and bought boutique firms, both based out of India and abroad, to fill the gaps in skill sets that they needed to offer to their customers. So what has been an outcome of this endeavor? Now, firstly, when we view the talent pool that exists in India as well as in the competing geographies, as per a study by Everest Group Research, India's talent pool ranks in the fairly mature category across all stacks of digital technologies, whether it is mobile, analytics, or cloud. And when we compare that with some of the competing regions, such as Poland, Argentina, and the Philippines, some of these technology stacks are in the maturing category and not in the mature category. So in terms of quality, the digital talent pool of India is right up there. But what is also relevant to note is that in terms of quantity, India is home to nearly 75% of the global digital talent pool, with slightly less than 900,000 employees skilled on digital technologies. And on that base, we are churning over 200,000 computer science graduates every year, making us a dominant region in terms of the quantity of digital talent. So while the quality and the quantity is up there, how do we compete on the price metrics when it comes to new technologies? Now here's the finding from another research by Everest Group, which showcases the difference in the price points of digital talent across these competing locations. By indexing San Francisco at 100, if that is what a digital talent in that region would cost, London would be at around 64, and then the Bangalore comes at around 11. So India has the mature quality, the highest quantity at the most favorable price point when it comes to these new technologies. And hence, it is not a surprise whether I am a buyer of digital services today or I am a supplier of these services. India is a key focal point in terms of adding talent to their digital mix. And hence, when we look at some of the new companies which are also wanting to grab their share in the digital pie, the likes of Deloitte, Ernst & Young, and KPMG, they all have fairly aggressive hiring plans within India over the near to medium term. And when we look at the buyers of digital technology services as well, now for these entities, digital is a key differentiator for them in the market. And hence, while they may be procuring these services from third-party vendors, they also want to have their own in-house capabilities for digital. And when these companies go on to invest in those in-house capability centers, India again ends up being the location of choice. As you can see that India is home to more than 1250 plus global capability centers or GCCs, wherein the tech talent houses for the likes of Tesco, Dell, JP Morgan, Volvo, etc. And as per NASSCOM, these companies end up driving 50% of their innovative transformation from it. So having established the relevance of Indian IT in the global technology transformation, let me just spend a couple of minutes talking about the financial parameters and the soundness of some of these metrics, given that these would be very relevant from an investment standpoint at all points of time. Now, the industry has traditionally and continues to check all the boxes with respect to the financial metrics, whether it is continued visibility for revenue growth, strong operating profits, return on equities, cash generation, and the capital returns to the investors. As we look at the first chart on this slide, now the growth continues to happen. And while this growth may have slowed down on a high base, that is understandable given the maturity of the industry at this point of time. What is also more heartening is that that growth continues to come at a fairly strong profitability, whether it is a tier 1 company or a tier 2 IT company. Now, this profit margin may have come down from where it was 10 years back. However, it does not really concern us so much. And the reason for that, we will just share in the next slide. Now, even though the profit margins of the industry has come down, what we see is that very interestingly, the ROEs for the technology universe has still remained intact at 26%, which is where it also was around 10 years back. Now, not only is this ROE much higher than the cost of capital, secondly, it is far better than the other companies in the Nifty universe as well. And also what we observe is that the ROE of the Nifty universe actually came down during this period, and which means that the gap to the universe has actually expanded for the Indian technology companies. Now, there are a few factors behind this, but one of the main reasons, as you will observe in the bottom right of this slide, is the increased payouts by IT companies in the form of dividends and stock buybacks in the recent years. As you would observe, for most of the companies, the percentage of profits paid back to the investors in the recent years have been much higher than the percentage paid out in the earlier part of this decade. And as a result of this, the ROEs of the companies have been stronger. But more importantly, the messaging has been very positive that the industry does not need to keep this large reserves of cash to continue growing. In fact, they can grow by paying out a lot of this cash to their shareholders as well. And this has definitely helped the PE multiples for the sector. So what does all this mean in the context of valuations that the sector has seen? So here we just plot a chart of comparing the market cap share of the sector versus the broader market with the profit share. Now, as we are all aware, the markets love growth companies and hence value growth the most. And what we observe is that in the earlier part of this millennium, when the technology sector was at a nascent stage and growing at a breakneck speed, its market cap share was far higher than its profit share, which means the industry was valuing it higher than what they would be valuing the broader market. However, there were intermittent periods when the growth rate of the Indian IT industry had suffered. Two examples that you can see in this chart are actually points in time, the first one being the global financial crisis, and the second one being the initial phases of digital transformation era, when Indian IT was just beginning to develop capabilities, but did not have them at that point. In both of those instances, what we observed was that the market cap share went below the profit share, undervaluing the IT services companies at that time. However, in the last couple of years, as digital has started becoming the driver of revenue growth for this industry again, we've seen the market cap share now becoming broadly equal to the profit share and the valuations reflecting much more fairly at this point of time. Now, another relevant point of discussion in any sector is the excitement of mid caps, or should we be invested in that as well? From an Indian IT services standpoint, we take a look at 10 to 12 prominent mid-cap IT companies which are investable being listed on the bourses. And what we observe is that in terms of scale, their cumulative size is a tiny speck in the global IT services context. While the broader market globally is almost $1 trillion, the tier 2 Indian IT is cumulatively less than 1% of that revenue market. Now, even when we look at the tier 2 in the Indian context alone and not in the global context, the market share in the total IT exports stands at 5% as compared to the top 5 companies whose total market share today is as high as 40%. Now, we can hardly recount any instances in the past of a tier 2 IT company that has broken away from the shackles and gone on to match the size of a tier 1 Indian IT company. Instead, what we have seen is that the big companies have gone on to become bigger, whereas the smaller ones have struggled to keep pace, and the gap in revenues has only kept on expanding. Now, if that is the case, then why are we really discussing mid-cap IT at this point in time? The key reason to do that is that in the more recent years, they have improved upon their competitiveness and been able to grow at rates which have been much healthier as compared to the past. Now, there are two factors that drove this. Firstly, some of the promoter-run organizations of the past, they made way for professionally run managements who came in and executed far better. However, the major reason in our view was also the changing business dynamic of the way IT services were being bought. When we look at 15 years ago, a typical IT services deal would be in excess of dollars. The contract duration would be 5 years, and per year, the revenue from that contract would be higher than $30 million. Now, at that scale, it is understandable that any customer was very cautious of giving such a deal to a mid-cap IT company whose revenue size was less than $500 million. There were obvious execution risks in these mission-critical tasks, and they did not have enough references of executing such large deals in the past. Whereas the larger companies had a lot of references and customers had a lot of choices to pick from among the larger services companies landscape as well. And as a result, the mid-cap IT companies would not even qualify for many of those deals. However, as we span across generations of technologies, and in the more recent period, what we see is that the average size of an IT services deal has now collapsed to less than a third of what it used to be 15 years ago. Today, the duration of these deals is slightly higher than 3 years, and the annual revenue from these deals is roughly in the range of $15 million, or half of what it used to be. So at less than $50 million size of a deal today, this falls exactly in the sweet spot of a mid-tier IT company. And as a result, they have been able to compete with the larger counterparts on a much stronger footing and been able to win their fair share in the market, driving a better performance on revenues in the recent few years. So does that mean we would call triumphs on the mid-cap IT over the larger cap? We would not do the same, simply because of the fact that some of the risks that are embedded and inherent in the mid-cap IT model continue to be even today. And these are primarily emanating from the concentration of their businesses, whether it is to the top few customers or to the largest geography or to the largest industry. The revenue share of mid-cap IT from each of their key segments is much higher than a typical revenue share from their larger counterparts. And hence, were anything to go wrong in any one of these sub-segments, it ends up hurting mid-tier companies much more, whereas the larger companies are far more de-risked and are able to absorb those pressures better. But against that backdrop, what we see is that the discount that mid-cap IT used to trade to the large cap has kept coming down over the period of time. And today, that discount is virtually non-existent. But given the risks, we would be much more cautious and careful in terms of picking the companies to invest in the mid-cap IT space. And we should not forget the principle of mean reversion every time we observe such a trend play out in the markets. So I think to summarize, I think in the Indian context, cricket is a good analogy to explain any phenomenon. And without really speaking much and letting the slide pictures do the talking in this instance. All I would end up saying is that the large cap companies are the so-called evergreen businesses, which have stood the test of time and hence offer themselves as a long-term compounding play. And on the other hand, mid caps, yes, they will have their days in the sun, but they will remain more cyclical. And hence, our approach to investing in mid caps would be far more tactical as compared to the large caps. So, how do we see these trends play out in the medium to long term for the industry? Now, I would just like to share a couple of trends that we see playing out, and then one hope from an investor's perspective that we foresee coming for the industry. Firstly, one of the key constraints to the valuation multiples of Indian IT in the past had been their growth visibility. While digital transformation was a trend that was also playing out in the pre-pandemic era, however, there were a few customers who were much more aggressive in taking to this trend, whereas there were a few others who were much more slower on the progress on digital transformation front. But what the pandemic has done really is it's fallen like a wrecking ball on those companies who were sitting on the fence with respect to their digital transformation decisions. And now, with the broader enterprise customer base on board with respect to this digital journey, the growth runway for Indian IT is fairly well established over the next few years. But that said, there will always be potential spoilers to this party, and there are a few risks that we must keep watching for. The first one being the global macro environment. And a digital journey for any customer requires a large amount of capital over a multi-year period. But if the customers see the economy weaken and the visibility of the business prospects are weak, then such capital commitments are unlikely to come through. And hence that would be a risk over the medium term. In the more near term, we are observing the rising spike in the infection cases across Western Europe and also in the US, and some of these countries going back into the lockdowns. That could have a near-term impact on demand. Plus, second half of any financial year is seasonally soft for the industry. So we would watch out for both of those backdrops against the valuations which had a fairly robust rally in the recent past, and hence we would not be surprised if that rally takes a breather in the wake of these risks. Now, while demand is one dynamic, the other important dynamic is supply. And as we mentioned, that Indian IT had developed the skill sets in the digital technologies, but in the fast changing technology landscape, the companies need to continuously keep upgrading and reskilling and upskilling their employee base. And this ecosystem needs a contribution not just from the industry alone, but also from the educational institutions as well as the policymakers. But on the policy-making front, there could be risks coming in from protectionism. As we have viewed in the recent past with respect to the hostility around H-1B visas, which have restricted the entry of Indians into the US offering technology services. Now, depending upon the election results in the US, we could have an offshore tax also being levied, as is being spoken in some circles within the economy. And so those are the risks to watch out for, while the overall opportunity over the medium to long term looks very robust. The second key trend that we expect to continue playing out is that of consolidation in the industry. What we have observed in the last 10 years is a lot of small companies getting folded into other companies or getting bought out by private investment equity firms. Now, that trend can continue to play out going forward as well, because the reason why some of these companies have been selling out is that digital pivot is not a trivial task. It needs two imperatives. The first one is to invest heavily to reskill and build digital capabilities. These investments need to be both organic and inorganic. And the second one is to be willing to cannibalize your own traditional revenue sources in order to pivot to the new. Now, not many companies had been able to take that shift, and as a result, they got bought out. The second reason for consolidation has been some companies who on a smaller base were much more agile, and hence they made the digital pivot much faster than the others. Such companies obviously become attractive acquisition targets for the larger companies, and we've seen that play out as well. And we see both of these trends playing out going forward, considering the same challenges are offered by the technology landscape, and the industry still remains fairly fragmented. Now, lastly, while we all like linear compounding technology investment plays, but we would all love exponential plays as well, right? And an exponential play typically comes in the pioneering cycle of any new technology. And we've seen that example with the likes of Amazon's in the US. What we observed is that Amazon was a beneficiary of two such exponential cycles. The first one being with the consumer technology cycle that came up when they launched e-commerce. And the second one came with the enterprise tech cycle when they came up disrupting the technology world by launching their cloud computing services with AWS. And obviously, while there was an IBM in the backdrop as well, but those linear returns of IBM during this period get eclipsed by this exponential growth that Amazon saw during this period. Now, when we look at it in the Indian context, India also has their fair share of consumer tech as well as enterprise tech plays, which are proven business models and valued at a fairly healthy level by the private investment circles. And these companies are readying their IPOs in the near to medium term. So we are hoping that we will also be able to partake in some of these long-term exponential growth journeys of these companies in the times to come as a part of our technology investment portfolio. Now, while that opportunity is great and very lucrative, we should not get caught in the hype. As we've seen in the past, an example of this one company which spoke about bringing Amazon to the remotest villages of India. And as a result, the stock soared without much due diligence happening on how would they do it and whether it was a viable model. What followed were some concerns around corporate governance, and then also the proof points of how such a offering may not be viable. And as a result, the stock came crashing down again. Now, this was one of the stocks which was a part of a relevant NSE index as well, a name that we would not have invested in. But the key takeaway from this is that we should not really forget the first principles, and we would always continue with our diligent and prudent approach, keeping our investment framework in mind, even though these opportunities look very exciting. And on a parting note, if that due diligence is taken care of, there is no doubting the appetite that the investors would have for such stories. Now, India has not really had many opportunities to participate in these consumer tech and enterprise tech plays today. And as a result, what we see is an example in this slide of a company which offered an indirect play into the e-commerce route, wherein while it had its own business, it was also invested in a few startups that have scaled up successfully. And so during the pandemic, though the core business of this company also got badly hit, however, just because it offered that indirect entry into some of these exponential tech plays, the stock ended up outperforming significantly to the index, despite its core business taking a massive hit. So I would like to end on that note, and thank you all so much for listening patiently, and over to you, Manish.
Thanks, Ashish, for your wonderful insights. Friends, we also have with us Anshul Sehgal, who's the head of our PMS business. I'd like to call upon Anshul to take this discussion forward. Thank you.
Thanks, Manish. Good afternoon, everyone. Thanks for being on this presentation. I'm going to talk about the Kotak FinTech portfolio strategy on the PMS platform. Through this strategy, we are looking to leverage the IT and tech opportunities that the Indian market throws at us. In addition to that, we are also looking to leverage the financials opportunity. And it's a combination of these two opportunities that we are playing through this portfolio, the FinTech portfolio. Two themes which we are looking to participate in. One, financialization of savings, and second, digitization as also IT services outsourcing from the Indian market. These two themes are what we are participating in the portfolio. Within financialization of savings, there are various segments that we are participating in. One, of course, online transactions. For instance, in the recent times, we've seen a spate of online transactions happening. and the quantum of online transactions has gone up many-fold over the last, you can say, about 6 months, given what has played out because of COVID, lockdown, etc. Uh, the result of all of this is that players who are actually catering to online transactions, whether they are credit card companies or other fintech businesses, those businesses are benefiting immensely. Through this portfolio, we are participating in this theme through our portfolio holdings. The other space that we are actually participating in is the banks and NBFC space, where again, we believe that the runway for growth can be quite substantial over a 3 to 5 year period, particularly for banks which are well capitalized, as also NBFCs which are well capitalized, and where credit mechanisms are well in place, and they have systems which allow for them to grow over a long period of time. Such banks and NBFCs are what we are participating in this portfolio. Life and general insurance companies are at a very nascent stage of growth. We do believe that the advent of COVID will accelerate this growth for many of these segments, particularly, say, health insurance, for instance. That as a segment is going to see a significant fillip because of COVID. As also life, we do see that segment actually seeing tailwinds going forward. Capital markets plays like asset management companies, those companies and those businesses are also going to benefit going forward, and the portfolio participates in their growth. Digitization and IT services outsourcing. In our judgment, the world is going to become more digitized. It is going to require more work from home and offshore work, as a result of which IT services outsourcing is going to become a significant theme going forward. India has a huge ecosystem to play this theme, and there is also a large workforce which is available in India, which is educated, as also participates in that work from home, offshore working kind of an environment. And we do believe that there are multiple companies listed on the Indian exchanges which will participate in this theme going forward. There are companies which also cater to next-gen technologies like cloud computing, Internet of Things. These are companies which either manufacture products or are companies which are catering to companies who have products of their own. That space is something that this portfolio captures through portfolio companies. Other segments of this space that the portfolio will look to build in are artificial intelligence, robotics, and cybersecurity. We do believe that the portfolio is very well balanced to take advantage of these opportunities going forward. The structure of the portfolio as we speak is such that we have 57% of the portfolio invested in technology, and the remaining portfolio leaning towards financial and insurance kind of businesses. The top 4 holdings in the portfolio are Infosys, Tech Mahindra, ICICI Bank, and Axis Bank. In addition to these companies, we have in the range of 15 to 20 names in this portfolio, and hence it's a concentrated play on these 2 sectors. Our leverage towards one segment of the portfolio or the other will depend on our assessment of valuations, of the trends going forward, of market trends, and hence there will be a shift between technology and financials within this portfolio. There was a time when financials were overweight. At this time, technology is overweight, and that mix may shift as the situation changes and as we realize that there are opportunities in the other segment which are more lucrative at that given point in time. The portfolio focus in general is to participate in earnings growth and buy into companies which have reasonable valuation. And it's an amalgam of such companies that this portfolio comprises. And we do believe, as I mentioned earlier, that this is a portfolio which can give handsome returns between now and the next 3 to 5 years. Thank you very much. Thank you for your patience, and I'm happy to take questions.
Yeah. Thank you, friends, for being here with us, and thank you for the lovely presentation by Shibani, Ashish, and Anshul, and for all our participants who have been on this call. We're open to taking questions. If anyone has any questions for our panelists, you could post it on the YouTube chat, and we'll be happy to take them forward. Harsha, there are a few questions which have already come in. I wanted your view. So while this presentation today spoke about the IT sector, so there are lots of participants who want to know that as a fund house, what's our view on the sector and how are we positioned across our mutual fund portfolios?
Thanks, Manish. As you would see in our portfolios, we have been quite overweight in many of our portfolios on IT sector. For example, focused equity, Kotak Blue Chip, and Kotak Tax Saver are currently overweight on the sector, and they are benefiting from the up move that we have seen in IT sector. In fact, across the board, while there may be some small underweight or neutral exposure to IT, most of this exposure has been built over the last couple of quarters when COVID hit us, wherein the revenue momentum was more or less similar to what was expected earlier. And then later on, it turned out to be slightly better. But I think on the cost side, there was significant improvement that we saw from most of the IT companies. So to that extent, I think suddenly this sector became a sector which produced better profitability than many other sectors which were kind of adversely impacted because of COVID. And that was the time period when we actually started to increase our IT exposure in our portfolios. Most of the portfolios have been overweight on large cap IT, but on the mid caps, as we discussed during the presentation as well, it's been more tactical and stock specific. But overall, we continue to have very constructive view on IT and continue to have large positions on an absolute basis in most our portfolios. So I would say that apart from the three portfolios that I mentioned, which are overweight, which can gain if IT sector outperforms, even the others are reasonably strong in terms of IT exposure. So they are also well diversified with other sectors. One could look at that. And then finally, Kotak Pioneer is something that investors could look at, wherein roughly 22% is in international technology space, where we have invested through CI Signature Global Innovation Fund. And the rest of the money is invested in domestic equity. And we are looking at three criteria for investing into domestic equity through Kotak Pioneer. The three criteria are: the business model should undergo some change, either through use of technology or by any other means. That's one of the criterion. Secondly, there has to be a new product or there has to be a new service. So if any of these criteria are met, then we take those companies in our portfolio if valuations are in our favor. And also, as I said, more than 20% is invested in international technology space. So to that extent, I think that's something which can be looked at as a larger exposure to IT sector, not just from domestic perspective, but also from the global perspective. So I think these are some of the funds that one could look at.
Thanks, Harsha. Harsha, there's another question which has come up that, with ESG as a theme playing out and gaining a lot of prominence even in India, there's a question by a participant who wants to know that have we started factoring the IT sector on the basis of ESG scores?
We are the first signatory to UNPRI in our country. So to that extent, our research process is taking ESG into consideration while evaluating companies. And as far as IT sector is concerned, clearly one of the factors out of the E, S, and G is definitely not going to impact them adversely, which is environmental standards, because most of the IT companies will have nothing to do with impacting environment. As far as governance standards are concerned, clearly, I think our IT companies have shown that they're one of the better governed businesses when you look at domestic market. And similarly, on the social factor as well, they have scored quite well. So when you look at overall ESG score for IT sector, there could be companies which are some exception, but broadly, they are one of the better lot in terms of ESG scores. So yes, I mean, as and when you need to really choose companies from ESG filter, I think most of the IT companies would really fare well.
Sure. Asha, I mean, if Shivani, Ashish would like to take this question. I know Ashish and Shivani also mentioned about the US elections, but the other question which our participants want to know is that with the change of policy, I mean, the change of government potentially in the US, how does it impact and their policies impact IT sector for India?
So yeah, hi. Whenever there are US elections, there is always a lot of noise around protectionism and visa-related issues. In fact, over the last few years, we've been seeing that there is heightened protectionism in the sense that the quantum of H-1B visas being granted has been coming down. And Indian IT companies have actually been preparing for this for the last many years. A lot of companies have set up their own centers in the US. They've increased their US hiring. And as a result of which, presence in terms of hiring directly from campuses in the US has also gone up in preparation of this heightened protectionist kind of an environment. Also, another outcome of COVID would actually be better offshoring or higher amount of offshoring, because every company is focusing on cost, and therefore for every element that they want to bring down, and that can be done through offshoring. So actually COVID does hasten the process of offshoring to some extent. In terms of the overall noise around what we are seeing today, of course, it will possibly die down over the next few days once the elections are over, and you will start getting back to business as usual. So it is temporary in nature. It does happen closer to the elections, and then it starts to die down. And therefore, we need to look at these companies on a slightly longer term structural basis.
Thanks, Shivani. Shivani, it's been observed, that whenever the rupee starts to become volatile, IT as a sector is one sector that people tend, say that will be the big beneficiary. So looking at rupee dollar volatility and the way ahead, how do you think it's going to keep impacting on the IT?
So, while it is commonly believed that a depreciating currency results in better performance of IT services because it impacts their margins positively, but if you look at the last 10-year period where the Indian currency has actually been depreciating, margins of IT services players have not really improved. So as a result of which, it's not a one-to-one correlation between currency movement and margins. In fact, if you look at what is really driving stock performance for IT companies, it's more revenue growth rather than currency. And therefore, in an environment where revenue growth trajectory starts to improve because of better deal flow, that is when the IT companies start to perform, because that flows through in terms of better earnings growth. So while it's a common perception and belief that a depreciating currency is beneficial for the sector, but I would suggest that one looks more in terms of revenue growth trajectory, as well as whether that is flowing through in terms of better earnings profile as well.
Okay. While our presentation and knowledge series today was specifically on IT sector, but someone wants to have a view on what's our outlook on pharma and healthcare, both domestic as well as global. And I think since we have a pharma healthcare strategy running on our TMS, Anshul, would you like to take this question?
Yes. Thanks, Manish. I hope I'm audible.
Yeah.
Okay. Thanks, Manish. Yeah, the pharma and healthcare strategy and that space overall is at the cusp of a significant turn upward. And this is a multi-year underperformance that this segment is coming out of. And between now and the next 3 to 4 years, we could see a secular uptrend in this space. Now, this segment of the market used to be roughly about 8 to 9% of the total frontline index weight till about 4 or 5 years ago. And in the last 4 or 5 years, it has come down to 4.5%. Now, the journey for reversal of this trend and moving upwards towards that peak level of 8 to 9% of weightage has commenced. We are still seeing initial signs of that, even though much of the return has come in the last 1 year. But if you go back to, say, over a 3 to 4 year period, in that period, Nifty Pharma has more or less been flat, which tells you that it has only covered up the underperformance over a 3 to 4 year period. And we are also seeing that because of the COVID scare and general movement towards safety and health, investments in pharma and healthcare are moving up quite significantly. Our portfolio is, which is the pharma and healthcare portfolio, is geared to take advantage of this opportunity. We have some of the leading pharma companies where valuations are in favor, balance sheets are very strong. In addition to that, we have companies which are geared to take advantage of new trends in the sector in the form of contract research, manufacturing, contract development, as also API manufacturing. And the portfolio, in fact, has done quite well in the 3 years that investors have invested with us, or 4 years. A crore of rupees invested with us is today about 1.55 crores or 1.6, between 1.55 and 1.6 crores. In the same time, an investment in Nifty itself would have been 1.25, and in Nifty Pharma would have been 1.05, 1.1 crores. So the portfolio has done very well. The sector is in favor. There are tailwinds of investment, and we are very well positioned to take advantage of it. It's an interesting opportunity at this time.
Thanks a lot, Anshu. There's one question which basically someone wants to know that in terms of from an offshore taxation perspective, would that impact revenue for IT companies in India?
Is that directed at me?
Harsha, anyone wants to?
Ashish, would you want to respond to that?
Yeah, sure.
Yeah, Ashish, would you?
Sure. Thanks, Manish. Yeah. So, see, as far as offshore taxation goes, it is one of the points that are being spoken about. Now, there is one risk that is believed to possibly come through is if Biden comes in, then there could be an offshore taxation levied on outsourcing services. Now, what we've seen is that these are some of the sort of highlight news items that we are used to listening during every US election run-in. And whether the ruling party is a Democratic Party or the Republican Party, but protectionist rhetoric is here to stay. However, what is unlikely to happen is many of these bills seeing the light of day because these have been tabled almost every year since the global financial crisis now. And that continues to be the case. And considering the kind of job creation that not just Indian IT companies are doing in the US, but also at the same time, the leading global tech firms like Amazon and Google and Microsoft. So this ecosystem is now contributing much more proactively and progressively to the economy. And that is the reason why we've seen that in the last 11 years, at least nothing has come through. So it really needs to see the light of day for us to start getting worried about it immediately. And hence, we would wait and watch to see how this kind of develops because it first gets stable and then it has a series of steps to follow before it can actually become a reality, the probability of which still remains very low in our view.
Ashish, just following up to that question, someone just wanted to know that, when you would be doing, I mean, provided you're comfortable to answer that question, but primarily outlook for the next 3 to 5 years from a growth projection perspective, IT as a sector, how do you see it looking?
Right. Manish, just to clarify, your question is about the outlook of growth for the IT services?
Yes.
Sure. So if we look at the global services, and let's look at it in a top-down manner, right? So it's a $1 trillion industry today, which has on a global scale been growing at the rate of between 3 to 4% every year. However, what's been happening in the Indian IT context is that Indian IT is today roughly around 15% of this global market in terms of exports. And we end up gaining anywhere between 100 basis points to 200 basis points of market share from the global IT space. And as a result, the broader Indian market ends up growing in around high single digits. Now, when we look at 5 years out, while this trend of 3 to 4% global growth and 100 to 200 basis points of market share gains will continue, we have a couple of other tailwinds that could push this growth into a slightly higher trajectory, notwithstanding the macro risks that are also existent alongside. The first one being, like we spoke about in our presentation, about the accelerated manner of digital transformation. If anywhere between 20 to 40% customers were earlier aggressive on their digital transformation journey, we expect this number to be much higher and well above 50% today, because everyone feels and recognizes the need for accelerating their transition to cloud computing and other digital technologies. The second big tailwind for the industry has been the experience that the customers have had with Indian IT during the pandemic. While everything came to a standstill and when India went to a complete lockdown, there was this anticipation of a massive risk of how their daily processes will be delivered by Indian IT providers. However, fast forward 6 months down the road, what we've seen is that most of the processes got taken care of very seamlessly. And as a result, the customers have had a great experience and a fairly seamless journey. And hence, they are happy to now and more comfortable to now offshore much more than what they would have earlier done, on the basis of the fact that business continuity is taken care of even in times as drastic as this pandemic. So I think those two opportunities potentially can add on to what we have seen as the mid to high single digits revenue growth for the sector if the global macro returns to normal.
Sure. One last question before we conclude. And Shibani, this question I think would be best to answer. Friends, whoever are listening to our chat today, this is first of its knowledge series, and next month we will cover another sector in greater detail. But Shivani, there are a few questions where people want a view on banking and BFSI. So if you'd like to just give a view on that.
Sure. Thanks, Manish. So the banking sector clearly has borne the brunt of the impact of COVID and the impact of the economic slowdown. So we've gone through a period of moratorium for 6 months, and now there is this restructuring which is underway and which will get over by the end of this year in December. However, what has happened over the last 6 months is that while there has been this impact due to the COVID related slowdown, banks have done two key things. One is that they have raised capital. So as you are aware that some of the large private banks have raised capital over the last few months and they have shored up their balance sheets. Secondly, in the last few quarters, banks have also been taking higher credit costs or provisioning. And that means today, if you look at on an average for the large private banks, provisioning coverage would be anywhere in the range of almost 75 to 80%. Plus, they would have additional COVID-related provisions. What this means is today they are much better prepared to handle the issues in terms of incremental delinquencies that can crop up. While in the near term, there could be uncertainty because of the restructuring and the outcome on restructuring, because their balance sheets are much better, it is possible that over the next few quarters, they come back to a normalized run rate on growth. For the larger private banks, we believe that valuations are attractive, and therefore our positioning is towards some of these larger banks which have made provisions as well as have adequate capital on their balance sheet and will gain market share as and when growth comes back on the economy front. On the NBFCs, the situation has improved quite sharply in terms of liquidity, availability, and the cost of funds. However, there one must be careful on the asset side of the business, especially given the kind of lending that some of the NBFCs have done, and also given the fact that the moratorium level for the NBFCs was significantly higher than banks. Therefore, within the NBFCs, we prefer those which have a niche presence on the asset side, those which have excess liquidity, and those which have a strong parentage. And therefore, these are the market leaders in their specific segments. And the third segment that we like is the insurance space, both life and general, where there is significant under-penetration, and that is a compounding story over the next few years.
Okay, great. Thanks a lot, Shivani. Harsha, Anshul, Shivani, Ashish, thank you so much for your time and giving us an outlook on the IT sector. Friends, as we had mentioned, that this is first of its series. Next month, we intend to take up banking and financial services probably in more greater depth, like what we have covered IT. Just for the reference of everyone, there were certain questions which were specific to stocks. But this is a knowledge series where we are trying to give a broad impact and an impart knowledge on the sector as a whole. We are not here to discuss specific stocks in person. So if I have not answered or asked questions which are related to specific stocks, I hope you all please understand that and appreciate it, that this is a platform for sharing knowledge on sectors broadly as a theme and not here to discuss individual stock ideas. So I hope you understand the reason why I have not asked those questions. So friends, thank you once again for being there with us and taking time out of your schedule to give us this opportunity to share our outlook on the IT sector. And as mentioned, we will come back to you next month with another sector with more greater depth and detailed analysis. Thank you once again, friends. Harsha, Anshul, Shibani, Ashish, once again, thank you so much for your time.
Thanks, everyone.
Thank you, everybody. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.